really gone too far back to revisit that level. Now we've got this kind of 54.40, 54.60 level that we seem to be kind of working through. But again, that uptrend for June intact, even as we get to today, not necessarily great looking candle, but nonetheless still respecting that upward sloping trend line. And of course, we've got a couple of other indexes that I think are probably something we should take a look at as well. I'm going to kind of start and work my way through this, but if you know us, we've always talked about the Russell 2000. Really not a pretty picture for the most part, right? Even if we go back further to multiple years, we talk about the rut being in a rut. I think that's a common refrain here, but nonetheless, you can see what June looks like. Not really much to write home about, right? I mean, essentially, we've seen the Russell 2000 in a bit of a downtrend since going back to what, middle May, and again, kind of getting stuck in this area and not really doing too much other than this downtrend that it's been sticking to, except for today. We popped out, but again, not a really great looking candle. So we'll see kind of how this plays out going forward. Moving next to the S&P 500 equal weighting. Again, not a very impressive month for the most part, right? We can see I've drawn in this triangle here, this symmetrical triangle. Uh, but really, if we take a look at June, we've been pretty much stuck in this range, right? In fact, if we take a look at the last candle from May, that's really been our range for the whole month, except for a couple of instances of poking out. But nonetheless, relatively tight range. And this is the triangle that I'm watching. We'll see how this plays out, but I'm looking for maybe some kind of movement here in the near term, whether it be up or down. But certainly seems like we're coming to a point here with regards to the S&P 500 equal weight. Moving to the NASDAQ, slightly different story here, right? Of course, we can see that with regards to this one, the trend seems to be intact for the most part for the entire month, just kind of riding this thing up, much like that S&P 500 chart that we looked at. Relatively strong. I think that, and we'll get into sectors, of course, with Jake, but certainly we've seen some leading sectors and leading industries that would be, certainly reflected in the NASDAQ as well. And then one final one that I wanted to kind of show here, and that's the NY Fang. If you're not familiar with this is essentially 10 stocks, 10 tech stocks that are weighted in an index. And of course, it includes many of the popular names. But to me, this is kind of another telling chart, right? We've certainly seen this industry, the tech industry, be a leader, and this certainly tells a bit of the story as well. It's again for June, moving straight up, a slight pullback, but really not much of anything. And here we are again, heading straight higher. We can even say that this trend that we looked at from the middle of April is intact, and we might even have to draw a second one with a different, slightly steeper angle, but nonetheless, that's really been the case for those stocks. So I'm going to flash this, Jake, before I let you take over with regards to the sectors, because I know that's going to be something you want to talk about. But I kind of just took everything and cleaned it up and threw it in Excel so we can get another view. Sometimes I throw the compares up with the other lines, but it gets a bit chaotic when you start throwing in a bunch more. But take a look. I mean, this tells the story to me, at least. Here's the S&P 500 right in the middle. We've got the Russell 2000, as we talked about, just a laggard for the most part, not doing too much. The S&P 500 or the S&P 500 equal weighting again, pretty much flat for the month. I mean, not doing a whole heck of a lot. And then we start to see really the story as it unfolds. It's the Nasdaq doing even better than the S&P 500, and of course that NY Fang, those 10 stocks, that narrow breath rally that we've been used to probably. Really, for the last year, maybe even more, right? Last 18 months or so, that we've been talking about that type of rally. But I know certainly, Jake, you've got some sector information that you want to run through, but I thought this might be a good lead up to what you had to speak of because certainly some good information about the overall market and how we see things playing out. And as we lovingly refer to you here on the desk, Sergeant Sector, I hope you can take over and give us some information about those sectors.
All right, glad to do so here, Albert. Folks, welcome. Thanks for your attention so far. A great review on where we sit so far. Some of the interesting themes, we're clearly seeing some outperformance from those big players in the New York FANG index. That's an interesting viewpoint, and we'll see how that compares to it as we break down the S&P 500 by sector. We've got a couple ways for us to do so, and let me just go ahead and get this presentation up in front of you. Here we are, and we'll start with this one. All right, folks. So this will be our first glance at how the sectors are performing. Specifically, what we're seeing here is a year-to-date viewpoint of all of the sectors and how they have performed. Clearly, there's a couple leaders on there, and those ones happen to be information technology, way up here at almost 30% positive. This is as of first thing this morning. The market was open when I pulled this data, but the market did spike higher and then come right back down just a hair. It was enough positive to put the S&P 500 over 15% up for the year. Information technology almost 30, almost doubling the index. Communication services not far behind. And of course, within information technology and communication services, we find almost all of those New York FANG stocks, the biggest players out there. You've got your Apples, Microsofts, NVIDIA, you've got Google, Meta, and many others. So be aware that certainly there's been some strong performance from a handful of securities, and that has dramatically helped the market as a whole. However, year to date, here we are coming into this year, we're looking at 11 out of 12 sectors positive. Real estate's made up a little bit of ground. At one point, it was off more than 10% for the year, but it's now only off 5%, making up some ground. That's the year-to-date viewpoint that we're seeing right here. All told, almost everything is positive. The thing I would like to see some more of is a little bit more of equal participation. Right now, information technology and communication services carrying the entire weight of the S&P 500. That's okay because they are some of the largest pieces and the strongest performers. However, if we rotated and put, for example, energy or materials or even industrials as the top performing sectors and put these two back along with the rest, the S&P 500 would drop dramatically back down to about 10%. The weight of information technology, communication services is important to note here. That puts us in great territory, question mark. Great with a question mark because it has worked out so far, but it does point out the precarious nature with which we have arrived at all-time highs first thing this morning. Because, as we saw last week, NVIDIA hit an all-time high and then came down by 15% within 3 days. What if that happens to other stocks in the information technology or communication services? We see any sort of dramatic pullback in these large players, you can bet that that will create a bit of a domino effect, pulling down the S&P 500 and likely many of the smaller sectors as well, as when any of those big ones move, we're likely to see that happen. So let's focus on a little bit of the more recent information. Here is June and June alone, not year to date any longer, now just June. And you can see information technologies outperformance actually showed up in force this month. It started in May as well, but strong performance here for information technology this month. Communication services and consumer discretionary showing their hand as well. But take a look. Do we still have 11 sectors positive? Absolutely not. In fact, the one sector that was negative year to date, like I said, has been trying to make up some ground. Now positive 1% real estate. Well done, making your strides in the right direction. But take a look. 1, 2, 3, 4, 5, and 6 sectors, more than half, negative. True, they are some of the smaller sectors, with the exception of financials, which represents some 10% of the market capitalization of the S&P 500. But nonetheless, across the board, as we take a look, some good performance, but largely focused on just these 1, 2, 3. These 3 have been in the limelight on previous occasions as well. I'm going to jump a couple slides and take a look here. This is the year performance for 2023. This looks notably similar to me to the June performance. Information technology, communication services, and consumer discretionary as the positive and dramatically positive sectors. In that case, over 50% positive for these two on a year basis. But note that we still had some of the same ones suffering down here. Big difference is financials was negative in the month of June, but financials were positive 10% last year. Materials off this month, industrials off as well. So a little difference, but nonetheless, the unique nature of being carried by just these couple sectors is showing up again for the month of June so far, not necessarily for the entire period, but nonetheless, as we come back here to June's performance, take a look here. There's some clear similarities. I'd love to see these add to their previous rallies, add another 50% on top of the 10 they've added for the month. But folks, nonetheless, year to date, here's our look one more time, year to date. Tech up 30%. Communication services not far behind. They're keeping pace with what they did last year. The S&P 500 at 15%, also in that approximate area. So let's go ahead and take a look at the charts for a couple of those biggest performers. We'll jump over and take a look first at XLK, the technology sector. Like I said, there was a pretty dramatic pullback specifically from NVIDIA, but you can see how that spread into other parts of the market after it hit an all-time high. Pulling back on the sector as well. That was enough to put it below its 5-day simple moving average, the black line here, but not even enough to find the 20-period simple moving average. I told you that NVIDIA came down 15+%. Not quite as much when we look at it on a slightly diversified sector basis, only 4.25%, but nonetheless, 3 red candles in a row in pretty quick fashion. Enough to pull us back down, but not quite to the 20-day simple moving average. And 4 green candles in a row hereafter puts us back in the right direction. But note that technology sector, although it represents the strongest performer for the year and for the month, is not at an all-time high, whereas the S&P 500 did do so today. Some of that help coming from communication services and consumer discretionary to offset the weakness here in technology over the last couple days. Next, if we swing over and take a look at that consumer discretionary, XLY is the sector ETF for it. You can see that it's had a relatively rocky 2024. This month, June, was remarkably positive and some strong upwards trends showing up. The first time in a while that we've seen the 50-day simple moving average curl its way positive again, and the 20 doing so fairly dramatically, finding a positive slope, positive trend back in force. If we look backwards, it's been a while since we've had positive on all 3 of these. We'd have to look all the way back here till March since we had any sort of that consistent positive trend from the 20, 50, and 200. And even then, it was flattening out with the price pulling back pretty dramatically in consumer discretionary. This has been a very different chart than the year-long rally from XLK, from the long-time outperformance as well from XLC, the communication services. Take a look how clearly up and to the right this chart is moving versus consumer discretionary, which had that large question and sideways action from effectively the start of the year and only now starting to regain its footing. This one, we have hardly seen a time where any of the moving averages move negative. We look at the 20, did take a little break here at the start of April into May, but then came right back positive. The 50, though it flattened, never ended up going negative, and the 200-day simple moving average continuing moving in the right direction. It is, as you can see, pushing new highs today. It's pulled back just a little bit. If this holds here, we're looking at what you call a shooting star candle where it tries to go higher, then unfortunately comes right back down. I said yesterday in a burning ball of flames. We'll see whether this ends up managing to hold on or not. Be aware that this is what we're looking at today. Strong strength showing up from communication services, continuing to carry on the torch when XLK did stumble just a little bit. That was reassuring and frankly the only reason that the S&P 500 managed to avoid worse pullbacks right here on these 3 red candles. Great timing for a passing of the torch, at least temporarily, there to communication services. So that's a couple of the biggest ideas that I wanted to make sure we hit in terms of the sector-based focus, Albert. But we've got a lot more that we wanted to take a look at. I know you're hoping to identify some individual stocks as well that we can use to take a look at historical and recent price performance.
Yeah, absolutely. And I think that's a great way to think about it is that, obviously looking at the market overall, looking at the sectors, well, it's made up of individual stocks, right? And so therefore it's a good idea to kind of understand where we might be sitting with some of those bigger names that we've been looking at over the course of certainly the last year or so, right? To understand where things might be sitting right now. So I thought it would be a good experiment to jump into the screener tool, which is one of my favorite tools on Fidelity.com, and kind of just explore and figure out what we can find out for June and as well as the year to date. So the first thing I'm going to do is I'm going to start with just a straight up clean screener, start from scratch. And here's the first issue I'll tell you. If you're going to start to do this and you're going to start searching for best performance over the last 4 weeks or best performance over the year to date, I would tell you to maybe immediately limit it off the bat to certain names. So if I was to do that right now with all the names, we'd get some pretty whacked out looking low price stocks that have some unrealistic returns and might not even really be trading. So the first thing I'm going to do is just go down to here and go to index. And I'm going to limit our search just to the S&P 500 because that's really what we're talking about for the most part. So let's start with that to begin with. And let's start with just June so far. So now I can go back and look at price performance for 4 weeks. So that's going to give us, of course, the month to look at. And right away, we're going to get a list of all the S&P 500 stocks and their performance over the last 4 weeks. But let's just kind of narrow things down. And I really kind of want to just look at, for the most part, what has been positive over the last 4 weeks. So let's start with that. And so right away, we can see that of the 504 that we had, 265 of the S&P 500 stocks are actually positive for the month of June. So roughly 52 to 53% of the S&P 500 was positive in June. Now, of course, that number can be relatively low or decently high. As of course, Adobe, you can see 22.63, CrowdStrike 22.59. So top 4 stocks are actually above 22%, and really the top 6 are above 20% returns for the month of June. If I was to reverse this and filter it by lowest to highest, you can see that there are definitely some that are sitting at that 0 or just under 1%. And quite frankly, there's quite a few sitting at just under 1%. If we were to scroll down and continue to look, we go all the way down this list, and it takes quite a bit for us to actually get to 1%. So certainly, yes, positive, but I don't think anybody's going to be clapping their hands or excited about those results over the course of a month. The other thing we can do is if we go back and take a look at that index that I was looking at before, we can see that as of June, the S&P 500 was up 3.89%. So let's take a look and see if we can't figure out what that looks like if we were to use just anything that's doing as well or beating the S&P 500. Well, that changes a little bit more dramatically, right? As you can see, only 124 stocks have actually kept pace or outpaced the S&P 500 in the month of June. That's about 25%, so roughly half or a quarter of the total S&P 500. And again, this goes back to the whole idea that we were talking about, right, Jake, is that narrow breadth rally being led by certain names, which that's fine. We can continue that as long as we want, but we also have to be aware of what that could mean, right? What the potentially that could mean in the future as we're watching these types of stocks. And the other thing too is if I go down here and if I pull up sector, industry, sub-industry, and I don't need to really do anything with sorting this, but I want to point out a couple of things that I thought were interesting because we just got done talking about this, right? What is it that's been leading us? Well, take a look. 37 of those stocks are actually information technology. So almost what a third I'm sorry, almost let me type of numbers here. 37 divided by 124. Yeah, 30%, almost 30% of the leaders have come from information technology. And as you can see, the other names that pop up are healthcare, consumer discretionary, as well as the industrials. So an interesting mix of companies that have done well in the last month, at least keeping pace with and outperforming the actual S&P 500. So that being said, as Jake was pointing out before, definitely you'll see those names that you would expect to see. And I think this one really stands out the most. If we dig a little deeper into information technology, well, look, 14 of the 37 are software, and 10 of the 37 are semiconductor and semiconductor equipment. So really that sticks with the narrative we've been talking about with regards to the New York FANG index, as well as the sectors that Jake was pointing out. So if we want to go back, and I'm going to go ahead and just clear this out one time real quick. And now we can go back and kind of review this once for the year to date. And again, I would expect that we start to see some similar results. Again, I'll filter it down to the S&P 500. And then I can go down to price performance for the year. And so if I go down to the bottom here, price performance this year. So I'll click on this year. And let's do the same type of idea. I'm going to start with 0 just to kind of give us an idea of which one of these have done well, at least from the standpoint of, at least keeping it positive for the most part, right? So again, if we look at here, we can see that 297 of the S&P 500 stocks have actually had 0 or positive results for the year to date so far. That's about 59% of the S&P 500. So a little bit better than than June, but nonetheless similar type of distribution. And we can see that if we were to sort this by price performance year to date, we get some familiar names, right? SMCI, Nvidia, and again, those have been outperforming for quite some time. But again, we can see a lot of these stocks are actually over 50% for the year. So some familiar names here on this particular list. Now, if we were to go again and do the same type of experiment, and if we start by looking at what has happened for the S&P 500 year to date, so 14.95. So now we can go ahead, now we can go back and do the same type of experiment with that. I'm going to change this to 14.95. All right. And now we can see, 117. This is roughly in line with what we were seeing before, right? We had 124 where we're doing as well as the S&P 500 or better for the month. So roughly about 25%. And year to date, we've got 117. So, again, relatively close to what we had expected to see here, keeping pace for the year to date as similar to June's movement. And we can go down one more time and add that industry sector and kind of get an idea of where things are happening. And what do you know? We get 30 of those 117 are actually coming from information technology. We get 15 from financials, 14 from healthcare, but another big one was industrials. Now, we didn't see that as much throughout the charts, but you can see that of that, a big portion is going to be machinery, and another big portion was aerospace and defense. If we go back into our information technology, we can see that, again, semiconductors makes up a big bulk of that, right? Over a third at 11 of the 30. And then some other distribution with technology, hardware, storage, and software, again, leading the pack. So I think that overall, Jake, if we take a look at what you were saying with regards to the sectors, and if we take a look at some of the individual performances for some of those big names, we start to get that cohesive narrative, right? That narrative of this narrow breadth rally coming from certain sectors. Obviously, information technology has been doing quite well for the year and for the month. The question is, does this continue, right? Obviously, if you've owned these names, you've done well. But as we always point out, there's always a time when maybe this doesn't continue and maybe we start to see something a little bit different. But as it stands now, that has been the leaders in the market. So I know you've got some other things you wanted to look at. Anything you want to add to this kind of experiment before we move on, Jake?
Yes, absolutely, Albert. So let's go ahead and take a look and see what we've got here and follow through on here as well. As we think about what's going on and how this is working, understanding a little bit about which stocks are doing well and how this breaks out across the broad scope, I hope can point out the difference in that overall performance. I said again yesterday, and I'll remind you today, folks, gravity doesn't always prevail in the financial markets, but what goes up fast can go down fast. It's not that what goes up must come down, because some things don't. But if they can go up fast, be aware they certainly can and sometimes do go down fast. If you're not in for the roller coaster ride, make sure that you're aware of the risk that you've taken in stepping into that pool. All right, let's go ahead and jump forward and take a look. This is the graphics that typically have adorned our presentation at the tail end, but today we're bumping it up to kind of middle of the time frame. We've got a lot of additional things to go through. Albert and I changing this up just a little bit today. Folks, take a look. Here's the review of last month's performance. In other words, this one is showing us performance from January through the end of May. So this is a month old, and comparing that year-to-date performance up until the end of May, this year we were at 11.3% positive for the S&P 500. And finding the 10 years in history that were most similar in that year-to-date start performance, this is what happened next, and that's what all of these different lines represent. The slightly thicker black line right here, that is 2024. And you can see this little crosshairs represents that turning over start of June and continuation through. This year's performance, June representing 3.8% positive, that's how we get to about 15% up for the year, is certainly an addition that is greater than the average. On average, these were posting 0.3% negative for the month of June. And if we measure it out through till the end of the year, although there was only one negative year, 1946, and substantially so, 20% off, nonetheless, we note that the average still works out to be a 9% average end-of-year positive return through the continuation. So that would represent an additional 5% or so on top of what we've already done this year. But we won't take too much time focusing in on what that would look like, given that this is the old data. But here's the update. This was what we looked at last time and now finished out with this month's performance locked in, stronger than average. If we rule out long ago years like 1946, in fact, this is now looking at just the last 50 years, anything 1974 and forward, now we're brought to only positive returns, at least through the end of the year, but there still was one negative for the month of June at 2.1% off. But nonetheless, in this case, it turns out our average was precisely in line with that recent time frame. 3.8% for June. We'll see if our average through the end of the year at 12.7% from the end of June through the end of the year would be consistent in our performance continued forward. But strong showing from historically similar starts to the year. As we continue on, now let's focus on that additional month's worth of data. Now, including from January through till June, what did we look like? This year, we were at 15.6%. This is as of last night's closing value. Since these take a little bit more time to prepare, I pulled this data last night and prepped this in anticipation of today's session. You can see that that brings us several very strong performances coming through leading into the month of July. And in these 10 years over history, the best performer was up here at 23% positive. 1954 was an amazing year for the stock market, continuing on through the end of the year. However, as we take a look down here, the average was far less impressive. Average coming through instead at 2.3%. As I'm eyeballing this, I'm noticing a discrepancy here in the years that ended up included on this one versus the other. So I apologize for that. I'll make sure I clean that up for next time. Nonetheless, as we take a look, our current year's performance at 15% positive, a strong performance year to date. If we swing over and take a look instead at the 5 years in the last 50 and their similarities, here we are seeing a strong performance coming through, positive for both the July expectation as well as for the average. But note that the average for July, at least, came largely because of the celebrations around my birth. I was born in 1989, folks. July, 8% positive, huge increase, and this is what's showing on. Unlikely that we'll get that continuation this year, but there were several that at least started or continued on strong at the start of July and only then later sold off. This one that came all the way down here is 1998. This was in the heat of some of the preparations for what became the tech bubble, but nonetheless, there was quite a pullback. This is 15% off from the start of the month, losing there on a couple occasions before finding its footing and moving right back up here and higher. So as we think about historical performance and what could be coming, here's our baseline understanding. Likely, July is shaping up to be positive if we look at historical results. And as we think through that, it occurs to me now what I was seeing in terms of discrepancy on this page, by the way, folks. It is accurate. All of them are showing right. I was looking at the negatives in this column, which were concerning me as there are no negative values through the year end, but through year end, there is exclusively positive values. Through both the month of July, 2-ish% positive expectation for years similar to this, and 9.7% positive through to the end of the year from this point forward. That certainly gives us some strong positive precedent. Only time will tell whether or not this time we're able to do the same. But as I glance at this year's performance and compare it to the others from the start of the year until present, I note that this hasn't been the most aggressive push. Some of those that ended at 15% positive to start off our second half of the year did so on the backs of much more dramatic pushes higher that then faltered into the current and then continued. This year has been more of a slow and steady, consistent upwards moves, in a few moments even being the worst of these 10 performers, and then only the consistency from the last 3 months showing up and allowing us to end at our current value. Anything could happen in the coming weeks and months, but that's our starting point in terms of understanding where we go from here. With that, the next viewpoint we want to take a look at is a little better understanding of what the Fed and their policies are likely to amount to as we look forward through the end of the year, and those changes in interest rates, since they've been so heavily viewed as market important and relevant. I think everybody there at Jerome Powell and Company is likely to be producing updated information throughout the year. You're the one who's kept most abreast of those, Albert, here on the team. If you do your best to share with us your insights on what we can expect looking forward, that would be appreciated.
Yeah, of course. And then I want to comment on that chart you got pulled up there before I go further, because this is a really interesting chart. And I think one of the things that I noticed immediately is sort of that summer sag, right? That summer sag where maybe things kind of slow down. You see how everything is relatively tight heading into the middle of the year. Then all of a sudden we get this section in the middle here that really is a massive dispersion of results, because you kind of get that slowness during the summertime and maybe things aren't quite the same. But then as you move to the right, you start to see once again all the charts start slowly, gradually, although more widely dispersed in the beginning of the year, they start heading up at that kind of that right 45-degree angle-ish. So interesting chart, Jake. I really enjoy this one quite a bit. I'm glad when you pull these up. But let me go ahead and grab the screen real quick, because I think that this is a really interesting bit of information before we even get into the actual Fed themselves. But kind of just talk about the macro picture, right? And this is a cool tool from Bloomberg that I think is extremely informative and fun to look at. But this is going back to the beginning of the year. This is their Bloomberg Economic Surprise Index. This is basically, they have built these daily indexes that aggregate economic data surprises across 99 US growth and inflation indicators. So in other words, things that came out above or below expectations, and how that affects the overall market. And this is going back again to the beginning of the year. So we'll start there and kind of go forward from there. But as you can see, if you take a look at the blue line, the growth line, it's been steadily moving for the most part lower over the course of the year. We did get some early on numbers that maybe gave us the idea that maybe growth was still accelerating, but then this starts to move lower and really just kind of gradually moves lower across the course of the year. And how do we justify that number or that information in that particular graph right there? Easily, right? We just had GDP, the final reading for the first quarter, and what did it come in at? 1.4%, dramatically lower than anything we saw last year, or at least at the end of the year, right? That third quarter, that fourth quarter. And here we are sitting at 1.4%. So that definitely makes sense given this information that we're seeing here and these surprises for growth starting to come in a little bit more negative over the course of the year so far. So, but I would also say that given this particular graph and thinking about, growth narratives as well as surprises, this is kind of what that soft landing looks like, right, Jake? We start to see the growth start to taper off a bit, but not at a steep angle, right? Just kind of gently turning lower at this point. So if we can maintain this particular type of level of slowing growth, that's what a soft landing is, right? It's not going to be perfect. You're going to see some bit of a pullback, but the key is not letting it go off the cliff, so to speak, right? On the other hand, we take a look at the yellow line. This is inflation. And as we can see, this one, started to pick up as we got into the first quarter of the year and started to move a bit higher. We've come off of that now. And so the question becomes, where does this go going forward? And again, if we kind of align this with the narrative that we've been thinking about recently, well, it makes sense, right? We got that first quarter, and really the first quarter was nothing but, for the most part, ugly inflation numbers, right? Things that the Fed did not want to see. The idea that if we go back to December and that Fed meeting in December, you kind of got the feeling that the Powell and company were feeling pretty good about the situation, right? Things have been going pretty negative with regards to inflation. It looked like we were turning the corner. He had his first utterance of the word cut in his post FOMC press release or press conference, and the market took off, right? What did we do immediately? We priced in 6 rate cuts for the year. Now, I always thought that was a bit ridiculous, but nonetheless, the market had priced that in, and it got really far away from what the Fed was actually telling us. So, that being the case, that was a completely different feel back in December. We head into this year and we start to see, we start to get some surprises, right? We start to get numbers that are moving up a bit higher. We start to get a CPI numbers that are printing well above what we thought they were going to be. And so what do we see? We see that those surprises start to move inflation up, catching the Fed a bit off guard. And then we definitely saw that over the course of the year with regards to their comments, as well as the information we got out of the FOMC meetings. Now, fast forward to where we are currently, and that is, of course, towards the May-June side of things, and we finally got a CPI print that was friendly to the Fed, right, or friendly to the markets, so to speak, and now we start to turn the corner. So now the question becomes, we're back at kind of these levels that we saw back in April. Does this continue to move lower and get us back to levels that are Fed friendly, so to speak, right? The nice thing is we've got one today, the PCE, which again, doesn't necessarily move the needle for the Fed, but it does kind of continue on this idea that we've started to move a bit lower, maybe even potentially heading lower at this point. The nice thing is that between now and the September meeting, which again, I don't think July, certainly every meeting is live. I'm pretty much willing to write off July at this stage. My focus at this point is certainly the September meeting. I think that one probably makes the most sense. I don't think November, it makes much sense given the situation with regards to the election, which Jake will get to that in just a moment. I think that September makes a tremendous amount of sense because think about it. If we're going to make a move on interest rates, right? The time to do that is it's a quarterly meeting. We have the opportunity to not only make a move on interest rates, but we have an opportunity to readjust our summary of economic projections and re-release that, the dot plot and everything. So what better way to communicate to the public and maintain transparency, but then moving our rates and also having that ability to do that as well. Now, mind you, I'm old school, right? From the trading floors. We always thought that the biggest moves would happen on quarterly meetings, not the serial meetings in between. I mean, but every meeting again is live, so it certainly could happen in November. But again, I think what makes the most sense is something like a September, maybe September, December kind of idea. But that's kind of how the macro numbers have worked out. And again, we've got plenty of things ahead of us that to look forward to between now and those meetings. We've got, an additional two more PCE readings before the September meeting. And I think that's going to be, very important because, at that stage, remember what Powell said? He said, look, I need to see more than just one or two data points. I need to see at least three. Well, guess what? He's going to have three data points between now and that September meeting. If they're all pointing in the same direction, maybe September changes a bit. But I do think that the market is kind of expecting that type of movement for that. And I'll get to that in a little bit, but I just want to pause there, Jake. That's kind of the macro overview of where things have been going. I thought it was important to kind of look at the two things that the Fed's looking at, right? Growth and inflation. And as you can see, you can start to understand what they're saying by looking at this graphic and realizing that, some of the numbers are coming in a bit different than what had been expected.
All right, let's go ahead and jump into these next ideas. You're absolutely right. We're going to take a look and see, having understood a little bit more about the economics behind it, seeing what Powell is looking at, you got to admit that the Fed has navigated this beautifully, at least so far. A soft landing, people said there was no possible way, and yet here we are seeing tightening overall financial conditions. And yet the labor market is nice and tight as well. Somehow they seem to have accomplished many of the things that they were going for. Inflation is starting to wane. Have we gotten back to the prices that we were paying at the grocery store 2 or 3 years ago? No, and we don't expect that will be the case. Inflation is a 2% ongoing, not let's go back to what we used to be paying as their goal. But nonetheless, they've somehow accomplished what seemed to be impossible. So kudos to the team at the Federal Reserve, likely avoiding many potential disasters along the way. So got to applaud them as much as they're in the spotlight and getting criticized. We'll take a look at this. But in terms of other opportunities for criticism, we're going to go ahead and step now into a hairy world of politics, folks. We do our best to avoid any actual political discussion here, and this is not meant to be a for or against on either party or candidate. But given that 12 hours ago or a little longer, we had the most recent presidential debate, given that we have 6 months or so, 5 months or so, until the presidential elections here in the United States, and that those are market-moving events, we're going to give an update on the materials that we went through 1 month ago. You liked it, and you said bring it back. So here I am, subject to your whims, ready to talk a little bit about elections. So let's see a few resources first. I will follow your coattails here, Albert, relying on some sources from Bloomberg, and we're going to take a look at them together right here. So this is the first one. This is an update from Predictit through Bloomberg telling us the likelihood of returns, the likelihood of the win for the presidential election during the course of the debate last night. The lines were more or less flat, perhaps ex-President Trump looking to regain that as the likely outcome, slightly less than 50% for President Joe Biden. But as we take a look, during the course of the event, huge increase in expectations for Trump, substantial decrease in expectations for President Biden. I think the most interesting part about these, though, is this. This one was running just less than 55 and ended over here at 57. Not a substantial increase after the initial spike. However, this one was running at about 45 or 46, 47 and tailed off and stayed at 31%. A huge loss, unfortunately, last night in terms of expectations for this, at least as read in by Predictit, and expectations likely expecting currently a Republican switch out, at least at the White House. We'll see what else happens going forward. Looking forward, a lot of this comes from a reliance on some of the calculations based on the Electoral College votes. I always have to remind myself every 4 years how this really works and what the ins and outs are. We'll always all have to focus in on that in a few months. But take a look here. These are some of the ways that they are being polled and considered as we add all of this up. So again, this is coming from Bloomberg. The map on the left is showing us all of the different states across the board. And actually, I meant to show you this one first, but I didn't really clean it up very well, but at least it's zoomed in just a hair. Here we've got the polled states down here at the bottom and how many votes are likely to come out of those states. Some very, very close, so they're being called a draw. And then the difference in electoral college votes based on polls. And then these ones being relied upon simply on the basis of historical voting trends. All told, votes counted, if this ends up holding true into the actual election, Donald Trump wins by at 302 electoral college votes, 226 to Joe Biden. This update does not come through given the overnight expectation from that change after the debate. Once polls come out and things change, if they follow suit with the expectations, it may be that things get that much worse for expectations for a continuity from the White House staff. As a result, now let's talk about the market performance in years past and years future. Let's take a look and see what we've got presently. So looking back over the course of the last 100 years, I identified each of the election dates and calculated the performance from the start of July through until the election. That's going to be our left-hand column, and our right-hand column from that election date through till the end of the year. Measuring these out, I'm going to use these box and whisker plots. I know that these are a commonplace tool for a statistician, but not for most of us, so let me walk us through it. If you take a look, we're going to find this white line right in the middle is our average value. In both cases, positive returns is our average as we come through July and continuing on for the month of second half of November and December. These ranges up here are everything inside of what's called our range, our interquartile range, taking a look at the highs and the lows and including those in it. And then anything that's represented here with a circle is one of those values, but is represented instead as an outlier. So they're so far away from normal average expected values that we're using a little separate notation. So those are the ones that we're going to call outliers. As we take a look over the course of all elections over the last 100 years, positive returns from July through until the end, but not remarkably so, only 3% positive or so through till the election, and then adding another 3% or so on average. But there were a few that got up here all the way to 20% and a couple negatives, including one scary one down here, negative 20% down, and the outlier up here at plus 60%. What a year that must have been. If we go ahead and take a look, though, at years more similar to this current one, or at least potentially so, here we've got years when the Democratic Party was in the White House. There's only 12 elections in the last 100 years where the White House was held by the Democratic Party. And at that point, take a look from the start of the year, from January 1st through till the election, you were looking at a little bit better returns, going through just less than 5%, range coming as high as 15%, as low as 2 or 3% down, and continuing on thereafter. This is regardless of who wins the election. We see slightly positive average results, but here much more varied. We're going to call this effectively a wash, some possible ups, some possible downs. But if we dissect that even further, actually, you know what? First, let's give a fair view and look at what the Republican Party would have done. Republican Party in the White House, again, 12 elections represented. It turns out there was 24 over the last 100 years. The 25th, for those of you doing the math, is this year. 24, taking a look over the course of the last 100 years, 12 of them with the Republican Party in the White House. Slightly average, slightly positive average, but this had both the extreme positive and extreme negative through till July. And in terms of year-end performance after the case, we see slightly positive with one outlier to the negative of 10% off. As we continue forward and dissect this a little further, what if the Democratic Party was in the White House and then lost the White House, lost the election, the Republican Party shows up? That's what's showing up in the polls presently. This is the most similar to what we were looking at currently. And from July through the end of the election itself, about 2.5% positive, one strong extreme here at 12.5%, but down here at the bottom, only negative 2.5%. So you'd have to say that there is a larger possibility for a strong performance through till November, but nonetheless, most were right here in this box. Continuing over to the right-hand side, not a single negative occurrence when that changeover did happen. Markets have reacted favorably to at least this change from Democrat to Republican in the White House, except this one down here, 7.5% negative, showing up as an outlier far outside of the expectation. Next, if we swing over and take a look again, if the Republicans were in the White House and then lost it, so this would be the most recent election, Trump loses to Biden. As we take a look here, there we had slightly positive results. We come over, swing to the right-hand side, and we see a few ideas on this vein as well, slightly positive. But let's go ahead and focus in on the most similar events. And here now we'll see it just slightly differently represented if you wanted to see the details of which years were up or which years were down. The blue bars represent the July through the election. The orange bars are election through that year end. So we can see our extreme positive year was far, far in the past. This was way, way back here, 1928. If we come over here and take a look at the biggest loser, this one was in 2008. Both of those happen to have been while Republicans were in the White House. Blame or not is not a game I'll be playing in this session. But as we take a look, nonetheless, year performances, the most recent election in 2020 was positive both leading into and following after. 2020 was also in the midst of COVID, so remember, this eliminates January through March lows and then is only benefiting from that continual rebound and push to new highs in late 2020. But nonetheless, after the election, even stronger performance as the switchover went from the Republican Party to Democratic control of the White House. If you want to see just the Democratic Party years, here it is. I'll give you just a moment to grab a screenshot and then jumping over and taking a look at the years instead for the Republican Party in the White House. Here you have it. Albert, we are only 3 minutes left. This class goes by so quickly. Do you want to go ahead and add in any finishing comments for us as we wrap up the session?
Yeah, let me just real quickly just share one quick graphic that I think is an interesting one as well. And that is, of course, my favorite topic, and that's the Fed. If we take a look at this, this is, again, another Bloomberg screenshot, but this basically takes all the Fed speak that we've seen and kind of throws it into a graph and kind of gives you a feeling of, dovish or hawkish, right? And again, I think this is a great graphic. It really speaks to what we've been seeing, and that is that when we get towards the first part of the year, relatively dovish, kind of on hold, higher for longer sort of narrative. And then we get into April, we start getting like Kashkari, for example, starts talking about maybe we don't need to do any cuts, so on and so forth. And we start to kind of edge higher in this hawkish kind of talk as we go forward. And then if we look at this peak, and I got another one where I actually gave the details. This is where Christopher Waller started talking about the neutral rate, right? In other words, that rate that is neither expanding nor contracting the market, basically, or the economy, basically saying that that neutral rate might be higher than we thought, and therefore that would imply that maybe we need to raise rates. And so that was probably about the hawkish highlight of the year. That was right at the end of May. And since then, we've come back down because essentially Jerome Powell, and whenever he has the opportunity, he likes to say, listen, I don't really want to talk about the neutral rate. You can't measure it, so therefore there's no reason to give it any credence here. But certainly a topic I'm sure that they have discussions about nonetheless. But as you can see, really coming back off and starting to kind of get this more dovish feel to it. I would say that I would definitely agree with that. I think that probably the conversations that we've been having and the things that we've been listening to is, the fact that the Fed wants to cut. It's just a matter of when. They're not really giving us any indication as to when that might be. Occasionally, we'll get someone say, "Hey, fourth quarter," once before the end of the year, but for the most part, they're keeping pretty close to the vest on that one and not really letting us know what their thoughts are. Again, the market's telling us maybe sometime in September or December by year end, fourth quarter, whatever it may be. But certainly, I think this keeps in line with what we've been seeing in the marketplace, and we'll see how the Fed plays out. They're the most important player in the market right now. We've had 4 meetings. We've got 4 left before the end of the year. Again, they're all live, but I'll be focusing on those quarterly meetings. I think those probably have the most bang for our buck. And so that's it. That's what we had to look forward to. We've got some meetings coming up. We've got a lot of numbers, a lot of data, of course, that they'll be looking at and the market will be digesting as well. And so I think that it should be a very interesting next few 6 months, Jake. I think it's going to be an interesting end of the year. So that's kind of my 2 cents. We'll see how the macro scene plays out. But hey, listen, thanks for having me. This has been a blast. Of course, I always enjoy sharing the screen with you, Jake, and love talking about data and numbers and macro stuff. So thanks again for having me. I hope everyone got a little something out of this one. I'd love to be back sometime in the future, but until then, thanks for joining everyone. Hope everyone has a great rest of their day, great weekend, and we'll see you next time.
We've said it time and again, folks, but these Bloomberg screenshots that we're sharing are unfortunately only a limited time unless we get feedback from you that says that they are worthwhile. If you got extra value out of any of those, let us know in the comments. We'd be happy to pass those along to the powers that be, see if we can keep these. Albert, thank you for joining me. It was my pleasure to have you alongside me. This has been June in Review, folks. I hope you enjoyed it. Next month, I happen to be out of town, so I'm not sure if it's you, Albert, that they tapped to fill in. You've done a phenomenal job. But folks, look forward to next month. We give you an update on these each and every month, and we'll continue to do so on an ongoing basis. Until that next time, we'll see you soon. Take care.